So, you have been at it for a while now and you're on a roll. Your equity curve looks promising. How do you feel? Serotonin levels in your brain are increasing. You feel light as a feather and you dance a jig. This is really dangerous. When trading, you shouldn't feel any of those, because once you start feeling like this is what happens. There should be no place for emotions in your trading. To be a successful trader, you need to put your emotions aside. This is where algorithmic trading comes in, and that's how I tend to algorithmic trading. An emotional trader's equity curve looks something like this, and then after a while it's like this. Basically, it's a boom and bust situation. I'd be interested to know what your equity curve looks like. There are various ways to improve your equity curve. In this video, we'll try and look at some of these using Mark Douglas's Trading in the Zone principles. You may ask, who is Mark Douglas? Well, if you're a trader, he is somebody you should really be familiar with. I came across Mark Douglas about 4 years ago, and what he had to say resonated a lot with me, and I diligently put to use some of his teachings, but I couldn't, for the life of me, overcome the human impulsiveness in me. And that's when I tend to algo trading. And you too can create your own algo that will give you signals of when to enter a trade and when to come out of a trade and when not to trade. According to Select USA, in the US stock market and many other developed financial markets, about 75% of overall trading volume is generated through algorithmic trading. So why not you? So why not join them? How many of you have read and reread this book by Mark Douglas and watched his numerous videos online and still getting nowhere? You're not alone, and you're not any more stupid than the best trader, nor is it your fault. How can you fault being human? Emotions are what separates us from machines and have ensured the survival of the species. However, these emotions are not conducive to being a successful trader. So let's take a look at what Mark Douglas has to say about becoming a consistently profitable trader and how an algo can help you to achieve this. Firstly, you must have an edge. Does your strategy have an edge? Do you know what an edge is? Basically, an edge is insight into a strategy that gives you an advantage or a slight advantage, increasing your wins over the losses. The edge could be in the strategy, technology, or even an indicator. So for instance, the big boys collocate their machines near the exchange to give them that fractional advantage, getting their orders filled in a timely manner. The second principle: I act on my edge without reservation or hesitation. Do you pull the trigger in a timely manner? Most retail traders get bogged down with further analysis just as they are about to put on a trade and end up missing the ideal entry. Once you've missed your trade, what do you find yourself doing? Well, chasing the price, of course, and end up entering at an unfavorable price level, thereby increasing your risk. Once your day starts like this, it's downhill all day because your psyche is doing a jig. Next, I predefine the risk of every trade. Do you predefine your risk before placing every trade, or do you do what feels right at that moment? Play it by ear, as it were. Obviously, this is asking for trouble, as you will not have an objective way to know whether your strategy is good or bad. Risk management is one of the most important part of trading. Without it, you won't have enough money to fight another day. Next, I completely accept the risk, or I'm willing to let go of the trade. This one is a biggie for the losing 95% of retail traders. When one completely accepts risk in trading, it means you're okay if you lose on this particular trade. You need to be okay with losing as long as it's managed loss. It's okay. But what do most of us do? We move the stop and start praying and hoping that price will soon turn in our favor. Obviously, it never does before you're wiped out. The next principle. I pay myself as the market makes money available to me. This is about profit taking and greed. Have you found yourself holding out your trade for a little bit more only to have it all taken away? Well, you're not alone. We've all done that at one point or another. Just take your profits as per your trading plan, full stop, and stand aside until another setup shows up. The next principle. I continually monitor my susceptibility to making errors. Well, this one is a biggie for retail traders, especially if you're at the beginning of your trading career. I must say, I'm not good at this, so I have software that helps me with this. This is part of reflection. Do you journal your trades so that you know what needs improving? How else are you going to learn? And finally, I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Really? Do you? Well, you can try. That's why I tend to a robot to do all that for me. Let's present the very same 7 principles to an algo and see how it fares. So taking Mark Douglas's The 7 Principles of Consistency. Have you objectively identified the edge? Yes. Have you encoded risk parameters? Yes. Have you completely accepted risk? Yes. Will it act on my edges without reservation or hesitation? Yes. Will it take profit as the market makes money available to me? Yes. Will it continuously monitor my susceptibility for making errors? No need. I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. It's hardwired. The most difficult part of creating a viable algo is coming up with a strategy that works. It's not a matter of throwing indicators on the chart and hope for the best. But how can you find a viable strategy, you may wonder? You'll be surprised that there are actually quite a lot of free viable strategies online which you can use as a jumping off point. A lot of experienced traders are so ready to share their expertise for free, which is something I really appreciated on my journey to being a profitable algo trader. These are equity curves of a fully automated algo strategy. The robustness can always be improved upon, and all strategies can fail, given certain market events such as black swan events. However, the premise is that you have a strategy that you believe has an edge. Once the strategy parameters are encoded, the algo will trade exactly as you have specified. This is a moving average strategy. The algo is set to trade just the regular hours, that is the New York session, and close trades at 3 p.m. Chicago time. It will only take long trades if the price is above the 200 moving average, and only if the fast moving average crosses the slower moving average. It will only trade in the 200 moving average trend direction, vice versa for shorts. There is no way that the algo will deviate from this plan, unless you change it, of course. It is not at the mercy of FOMO, fear of missing out, greed, wishful thinking, etc. So why wouldn't you use an algo to trade your own strategy? Please put your comments below and let's get the debate going. I hope you have enjoyed this video. Please give a like and subscribe. Thank you.